The stock market strategy that can make you rich, or wipe you out overnight. It's January 2021. A 34-year-old guy in a headband is sitting in his basement. He's got a beer. He's got a spreadsheet. And he's watching his account go from $53,000 to over $48 million. Meanwhile, across town, in glass towers in Manhattan, some of the most powerful hedge fund managers on earth are staring at their screens in absolute panic. How did a guy in a basement beat billion-dollar Wall Street firms at their own game? More importantly, what does that story teach you about how money actually works in this country? That's exactly what we're digging into today. Stay with me. This is going to change how you think about investing forever. Welcome back. If you're new here, this channel is about one thing: giving regular Americans the financial knowledge that used to be locked behind expensive advisors and Ivy League degrees. Today we're breaking down short selling, one of Wall Street's most powerful and dangerous tools, and walking through the GameStop saga that shocked the entire financial world. But here's the twist. We're not just telling a story. We're pulling out the real lessons buried inside it. The ones Wall Street doesn't want you thinking too hard about. By the end of this video, you'll understand what short selling actually is, why it can blow up spectacularly, and what moves the smart retail investor should be making right now. Let's get into it. How Wall Street profits when you lose, the hidden world of short selling. Let me ask you something. Have you ever watched a business in your neighborhood struggle, maybe a restaurant always empty, or a store with dusty shelves, and thought, that place is not going to last? Imagine if you could make money from that prediction. Not by doing anything harmful. Just by being right. That's the core idea behind short selling. Here's how it works in plain English. When you invest normally, you buy a stock hoping it goes up. You buy at $10, it hits $30, you sell, you profit. Simple. Short selling flips that entirely. You're making a bet that a stock will go down. Now here's where it gets interesting, and a little mind-bending. Short sellers don't even own the stock they're selling. They borrow it from a brokerage, sell it immediately on the open market, and then wait. If the price drops, they buy it back cheaper, return it to the broker, and pocket the difference. Let me give you a real-world example most Americans can feel. Say you believe a company is basically a sinking ship. Its stores are closing. Its product is outdated. Its competition is eating it alive. The stock is at $50. You borrow 100 shares and sell them. That's $5,000 in your pocket right now. 3 months later, the stock tanks to $15, exactly like you predicted. You buy back those 100 shares for $1,500, return them to your broker, and keep the $3,500 difference. You just made $3,500 without owning a single share. Sounds great, right? Here's the brutal reality no one talks about enough. In normal investing, the worst that can happen is the company goes bankrupt and your investment hits zero. You lose what you put in. That's it. Your downside is capped. With short selling, there is no cap on how much you can lose. Think about that. If you short a stock at $50 and it somehow rockets to $500, you still have to buy it back to return those borrowed shares. That $50 investment just became a $450 loss per share. There's no ceiling. There's no safety net. And the clock is ticking because the longer you wait, the more interest you're paying on the borrowed shares. This is why short selling is called one of the most dangerous strategies in the entire market. It requires perfect timing, nerves of steel, and even then, the market can humiliate you. Professional hedge funds with teams of analysts, mountains of data, and decades of experience still get it catastrophically wrong. Which brings us to the story that proves it. The $6 billion mistake. What actually happened with GameStop? Let me set the scene. It's late 2020. GameStop is, by almost every financial metric, a company in serious trouble. You know GameStop, The mall store where you trade in your old Xbox games for store credit that was somehow worth less than your gas money to get there. Digital gaming is taking over. People download games now. They don't need a physical store. GameStop's revenue is falling. Stores are closing. Analysts are skeptical. Wall Street smells blood. Dozens of major hedge funds pile into short positions on GameStop. We're talking massive bets, to the point where more shares were being shorted than actually existed as publicly traded stock. Over 140% of the available float was shorted. Read that again. They were borrowing and selling more shares of the company than actually existed. That's not just aggressive. That's reckless overconfidence. Meanwhile, over on Reddit, specifically a community called Wall Street Bets, retail traders are paying attention. Regular people. Teachers, nurses, veterans, college students sitting in their apartments. One of them is a guy named Keith Gill. Online, he goes by Roaring Kitty. He's not a hedge fund manager. He doesn't have a Bloomberg terminal. He has a YouTube channel, a Reddit account, and a very deep conviction that GameStop was actually undervalued. He posts his research. His spreadsheets. His reasoning. He puts his own money in and shows every update live on stream. And slowly, something starts building. Other retail investors start noticing what he noticed, not just the undervalued stock, but the insane overexposure of short sellers. All those hedge funds had borrowed and sold more shares than existed. Which meant, if the stock started going up even a little, those short sellers would be forced to buy shares to cut their losses. And what happens when everyone starts buying the same stock at the same time? The price goes up. Which forces more short sellers to buy to stop the bleeding. Which pushes the price up more. It's called a short squeeze. And once it starts, it feeds itself like a wildfire. In the first weeks of January 2021, GameStop stock goes from about $17 to $148 to $347, and briefly touches $483 in a single day. Hedge funds are getting destroyed in real time. Melvin Capital, one of the most prominent short sellers, loses over $6.8 billion. More than half their entire fund. Gone. In 1 month. Citron Research, a firm famous for publishing short reports on companies, publicly announces they're done publishing short reports. Done. After years of doing it. Because of this. And Roaring Kitty. His $53,000 investment becomes worth tens of millions of dollars. Regular people, coordinating through the internet, had caught some of the most powerful financial institutions in the world overextended and vulnerable, and squeezed them. For a moment, it felt like David genuinely beat Goliath. But here's the part of the story that doesn't get talked about enough. The part they don't tell you, what really happened to regular investors. This is where I need to be straight with you, because this is where the story gets complicated. Most of the breathless news coverage focused on the David versus Goliath narrative. Reddit versus Wall Street. The little guy winning. And that part was real. But here's what else happened. Many retail investors, everyday Americans, bought GameStop at $200, $300, even $400 during the peak of the frenzy. They saw the rocket emojis on Reddit. They watched TikToks saying, "To the moon." They felt like they were part of something historic. And then the stock crashed. Within weeks of its peak, GameStop fell back below $50. By summer 2021, it was under $20 again. The hedge funds that got squeezed early either cut their losses or found ways to manage their exposure. They had systems. They had risk controls. Some of them lost big, yes. But they survived. Many of the retail traders who bought in late. They lost real money. Money they couldn't afford to lose. Emergency funds. College savings. Rent money. So what's the real lesson here? It's not, Reddit can beat Wall Street. It's not, short selling is evil. The real lesson is this: understanding the mechanics of a market move doesn't automatically protect you from it. In fact, understanding it just enough to feel excited but not enough to see the exit, can be more dangerous than not knowing at all. The people who made money on GameStop were either early and disciplined enough to sell at a profit, or professional enough to navigate the volatility. The people who lost money were caught up in the emotion of the moment. And this happens constantly in markets. GameStop is just the version that made the news. The two-sided ethics of short selling, and why it actually matters to you. Let's zoom out for a second. Because there's a bigger conversation here that matters to every American who has a 401k, an IRA, or any money in the stock market at all. Short sellers have a reputation problem. And honestly, some of it is deserved. There are short sellers who don't just bet against companies, they actively try to tear them down. They'll publish negative reports designed to scare investors. They'll show up on financial news channels talking down a stock they're already shorting. They profit not just from being right, but from creating panic. That's manipulative. Full stop. But here's the uncomfortable other side. Short sellers have also been some of the most important truth-tellers in modern financial history. Enron, the energy company that committed one of the largest corporate frauds in American history and wiped out the retirement savings of thousands of its own employees, was flagged by short sellers years before it collapsed. The short sellers saw the accounting tricks. They saw the smoke and mirrors. They were right. Theranos, the fraudulent blood testing startup that claimed its technology could detect diseases from a single drop of blood, was called out by skeptics and short sellers while the mainstream media was running glowing profiles on the founder. Without short sellers, these frauds might have lasted even longer. More regular people might have lost even more money. So is short selling good or bad? The honest answer is, it's a tool. Like most powerful tools, it can build something or cause serious damage, depending entirely on who's using it and how. What matters to you, as someone who is trying to build wealth, protect your family, and retire someday, is understanding that these forces exist in the market. That powerful players are making calculated bets, sometimes against the very companies you might own in your portfolio. That knowledge isn't a reason to be paranoid. It's a reason to be informed. What smart retail investors actually do, the real takeaway. So let's bring this home. What do you actually do with all of this? Lesson 1: understand what you own and why. Keith Gill wasn't just buying into hype. He had done his research. He had a thesis. He understood the company. When the price went wild, he had conviction to hold, or the clarity to know when to exit. Most people jumping in during the frenzy had neither. Before you put $1 into any investment, know, why am I buying this? What would make me sell it? If you can't answer those two questions, don't buy it. Lesson 2: never mistake momentum for a strategy. GameStop was a story. It was exciting. It felt like a movement. But this stock is going up because people on Reddit are excited is not an investment strategy. Momentum can carry a stock absurdly high, and then drop it just as fast. If your entry point is based on FOMO, your exit point will probably be panic. Lesson 3: know your risk tolerance before you touch anything speculative. Short selling is not for most retail investors. The unlimited downside alone disqualifies it for anyone without significant capital and experience. But even regular investing in highly volatile, meme-driven stocks carries risks most people don't account for. The basic rule: never invest money you can't afford to lose entirely. If losing it would affect your rent, your groceries, your kids' lives, it shouldn't be in a speculative trade. Lesson 4: the market is not a level playing field, but that doesn't make it unwinnable. Hedge funds have advantages. Better information. Faster technology. Teams of analysts. That's real. But they also have weaknesses, like getting overconfident, overextended, and caught in their own traps. The GameStop squeeze proved that. Your edge as a retail investor isn't speed or information. It's patience, discipline, and time in the market. Index funds, consistent contributions, tax-advantaged accounts, these aren't exciting. They don't make for viral Reddit posts. But they work. Quietly, steadily, reliably. The billionaires panicking in January 2021 were not invested in index funds. They were overextended on a high-risk bet that blew up. Your slow, boring, consistent approach is actually more durable than their strategy. Remember that. Here's your homework for this week. Look at whatever you currently have invested, your 401k, your brokerage account, whatever it is. Ask yourself honestly, do I understand what I own and why? Do I know what would make me sell it? If you don't have a clear answer, that's where to start. Drop a comment below and tell me, did you follow the GameStop saga in 2021? Were you in it? What did it teach you? I read every comment. If this video helped you understand something you didn't before, hit the like button. It takes 2 seconds and it genuinely helps this channel reach more people who need this kind of financial education. And subscribe if you haven't. We drop videos like this every week, no fluff, no filler, just real talk about money that actually matters to your life. I'll see you in the next one. Stay sharp.